want to get a federal tax incentive for paying your state income taxes, it's actually fairly simple, but the new bill has added a little extra caveat, and we are here to talk about that. Your creative genius deserves the same precision behind the numbers.
Welcome to Let's Get Fiscal, hosted by Anastasia, Maisha, and Danielle.
Part of the women-led team at Coterie Tax.
From smart tax moves to cash flow strategy, we decode everything it takes to run a thriving creative business
so you can scale with confidence and sleep easy at night.
Press play and let's grow your business. Yay! Welcome back. So, pass-through entity tax. We hear it a lot. What is it?
Right.
What does it really stand for? What is it? What's going on with this?
Yep. And so even sometimes people will call it you'll just see PTET.
Yeah.
And
the little acronym.
Right. Because pass-through entity tax is a little bit tricky.
It's a mouthful. Yeah.
So pass-through entity tax is really a way where the business can pay for the state income taxes its profit creates.
Okay.
But because the business isn't required to, you are allowed a federal income tax deduction.
Ooh, okay.
So it counts as just a regular business expense, like if you were buying your own computer. So the first thing you have to identify is, do you have a pass-through entity? And what is a pass-through entity?
Those are two good things. Yeah. Okay. So what is it? And then we'll go into, do you have it?
Right. So a pass-through entity is really a business where all of its profit and activity gets reported, but it doesn't actually pay income taxes. It gives you a K-1.
Okay.
And then that's how you add the K-1 into your personal tax return. And then when you file your personal taxes, that's when the income tax for the business comes into play. So I always say a K-1 is kind of like a W-2.
Okay. No. That makes sense.
Okay. Every form has a different number, name, whatever. So a K-1, it kind of acts like a W-2, and it's really just showing the profit and activity of the business for you as an investor.
Okay.
So it'll show how, the profit. It'll show if you have any interest income. It'll show that Section 179. It'll also show how much you've taken in distributions.
Okay.
And then also, so an S corporation is a pass-through entity.
Yep.
And then also a partnership is a pass-through entity as well. So those two business types, you'll expect to have a K-1, and they are eligible for this pass-through entity tax.
Okay, cool.
So it's not for corporations, because corporations, they pay income taxes on their
actual income that the
own.
Okay. Yeah.
Right.
Okay.
Right. So a corporation acts like a person.
Yeah.
So it's going to pay income taxes when it files.
Yeah.
The income taxes. So it's already getting some of those benefits.
Okay. Yeah.
But when you move over to the personal return, there's what we call a SALT cap.
Oh,
so it's
so what's that?
State and local income tax.
Okay.
So that would be the state income taxes. It's your property taxes that you're paying. Sometimes there are city taxes, like the city of New York City. There's a lot of places in Ohio and Pennsylvania
that have it.
Those are a little bit notorious states. So right now there is a cap on how much you can deduct.
Okay.
Because before there wasn't a limit, because that would kind of play into your itemized deductions. Because you have that deduction that is the basic amount of money that it takes in order for you to survive. And so one of those items is the income taxes that you're paying to the states. And so it used to be fairly unlimited, but with the Tax Cuts and Jobs Act in 2017, it was limited to $10,000.
Gotcha.
And so for a lot of these pass-through entities, especially if they are higher earning, or let's say you live in California, your property taxes are already going to be over $10,000.
Yeah, for sure.
So then you have these expenses that are already considered basic necessities that are no longer going to be tax deductible. So you're paying income taxes on them. You don't get that, if you're in the 22%, marginal tax bracket, you don't get that deduction for them anymore.
Yeah.
So that can significantly have a difference on your income tax return. So what they've done to get around that a little bit is they created this pass-through entity tax where you've already maxed out the $10,000 deduction on your personal return. So what it's able to do is the business that has no cap on it can pay those state income taxes for you.
Gotcha. Yeah.
Then it counts as a federal tax deduction. And then the state, because the company can't directly pay your income taxes, the state gives you a credit. And so in some states that's refundable. Some states it just carries forward. It kind of depends. But the state gives you a credit, dollar for dollar, for everything the business paid. So it's technically not, but it is in a weird way, a roundabout way of paying for your income taxes. So that allows you to deduct more of those income taxes on top of the $10,000
on your personal returns. Okay. Yeah.
So when Tax Cuts and Jobs Act came out, and 2018, 2019, when especially business owners are like, this is bogus.
There's got to be some kind of workaround. Right. What can we do?
Right. So this is the workaround that they created. A lot of the communication from the IRS wasn't necessarily like yes or no. It was just like, oh, the way you are reading this, tax law, that is the way that it could be read, but there wasn't
so
really
it's a valid interpretation. I got you.
So once everyone kind of got that, we've gotten a lot of states that are on board. There's still a few states that are working through how to get this system, but definitely incentivizes the states because they get
money faster because it's quarterly for this. Is it typically, or is there different ones? Okay.
Yeah. Most of the time it's a little bit different.
Okay.
I mean, and in a lot of cases, you would still be paying this income tax on your quarterly estimates, just as as a person.
Yeah.
But technically they get a little bit more. In California, you're required to pay 9.3% of whatever the profit of the company is. But if your effective tax rate in California is only 5%, then California gets that extra 4%.
Yeah.
And they don't actually refund you. They just carry it forward to future years.
Yeah.
So
it really works for them. Yeah.
Right. For them to get 2 years worth of your income taxes right away, So again, that's kind of a planning piece that you have to be a little bit aware of.
Yeah.
But what the Tax Cuts and Jobs Act is, there's two separate items that affect the pass-through entity tax. So the first one is now you can deduct up to $40,000 of your income taxes.
Okay. Yeah.
So in some cases, maybe you don't need
the full amount,
the pass-through entity tax, because your income taxes are going to be under the $40,000. So then you can deduct them all. And I'll talk a little bit more about that and why you might still, you may still want to do it.
Okay, yeah.
Even if you're under that 40,000 mark. But also, really importantly, what they've noticed is, because like I said, sometimes the states will get more money than what you actually owe.
Yeah.
And you get a deduction for it. So what the IRS has said is you can't make, they call it these super payments.
Oh, okay.
So if your pass-through entity tax payment is more than 102% of the tax that you owe, then you don't get a federal tax deduction at all.
This is the thing that was the latest bill, right? They kind of capped it, but they legitimized it, but they also capped it. Okay.
Right.
Okay.
Exactly. And it makes it a little bit trickier because a lot of times with pass-through entities, their tax returns are due March 15th.
Yeah.
But your personal return isn't due until April 15th.
Yeah.
So this means you have to do both of the returns in tandem, because if you do the pass-through entity return first, you send it off in March, and you write that this is a deduction. But then when you file your personal return and you find out that the pass-through entity tax payment was over 102%, then you can't take that deduction. So then you're going to have to go back and remove it.
So you do have to do those at the same time. So it's really just planning it out, like making sure all your P's and Q's are in the right spots. Yeah.
Right.
Okay.
Right.
Okay.
Right. And so another thing that I'll go back to with, even though you can take an itemized deduction for the full $40,000, you may not want to because you may want to keep your standard deduction intact.
Okay.
And then take some of this on top of it.
Gotcha.
So your standard deduction is, because like I said, there's those minimum expenses that are going to be what the basic living costs for you. And so the IRS, they adjust it every single year.
Yeah.
So they'll give you that standard deduction. And then if you're able to provide receipts that you've actually spent more in those categories, then you can itemize. And then it pushes that deduction up. But let's say all you have, you have, your standard deduction is $16,000 and you have $17,000 in income taxes that for the state that need to get paid. Well, that might be a situation where you continue to do the pass-through entity tax, so you keep your standard deduction, and then you add on the taxes in addition to it, instead of replacing it. Because when you itemize versus standard deduction, it's one or the other.
Yeah, you have
so
to
if you do the itemize, then you only get the 17. But if you take the standard deduction and then you layer on the pass-through entity tax on top of it, then you're getting 16 plus 17, so 32.
Yeah.
As your federal tax deduction.
That's pretty nice.
Right.
Yeah.
Yep. So, but again, with this 102% limit, it does make things a little bit interesting.
Okay.
In a lot of cases for pass-through entity tax, some of the situations, you're going to have your payroll.
Yeah.
So the payroll that as an S corporation, you've given yourself your reasonable compensation, and then the remaining balance is the profit in the company. So your payroll, in some cases, is going to be higher than what the profit is. So you're kind of adding that in to your income tax. So then that means even though the business is paying the income tax on the profit, there's still going to be like a little bit left over because you have this additional income source. So you have to really be careful if you have multiple businesses that are coming into play.
Okay, yeah.
Because they'll net each other out and then you'll have a lower income tax and then you won't be able to do it on the one side. And sometimes that can be a little bit tricky because when the pass-through entity elects to do this pass-through entity tax, it's a lot of repeating words.
Yeah, it's okay.
Every single shareholder has to agree to it.
Okay. So
if you are, let's say you're a partner in two separate businesses, one of the businesses elects it and the other business doesn't, or even both businesses elect it, that could, it may not be deductible on you.
Gotcha.
So
yeah.
And it really has to be taken into account when you have all of those different,
like looking at it as a bigger picture and just like strategically determining where you might want to do it, where you might not want to do it, or if you do this, like knowing that there might not be something at the end of it. Okay. All right. No, that makes sense.
So a lot of the states require that you make the election before the end of the year.
Okay.
So especially in a creative business where you have a lot of variability, you may not know. You may have your jobs for the next 3 months, 4 months already scoped out, but you're not necessarily sure for the next 6 months.
Yeah.
And in New York, you have to make the election before March 15th.
Gotcha.
If you don't make the election before March 15th, you are not eligible. So, by March, you really don't know what the rest of your year is going to look
still
like.
Very beginning. Yeah.
So the only thing, even if you don't get the federal tax deduction, you're still paying your state income taxes, which you have to do regardless.
Yeah.
So even if you're kind of on the edge and you're not really sure, I would still recommend kind of having that in your back pocket, especially if in prior years you would benefit from it and you think that the year is going to continue to be the same. And in a lot of cases, it has to be similar.
Yeah.
Favorite your expenses. So that's where it's one of those things where you kind of want to hedge your bets, especially if it's money that's already going to be owed to the state.
Yeah. That makes sense.
So in New York City, you have to make the election March 15th, and then you make those quarterly payments. And then in California, if it's the first time that you're ever doing it, you make a $1,000 payment by June 15th, and then all the remainder is due by December 15th.
Okay.
And you want to pay it in full in that current year because taxes are going to be cash basis.
Okay.
So you can take the deduction when you pay it.
Okay.
So that's why you want to make sure that you do it in that tax year and not wait until the following year when all the books are closed and you know exactly how much it needs to be. And you wouldn't lose it. You just have to wait until you file the next one.
Yeah. Yeah. So it just pushes it back. Yeah. Okay. No, that makes sense.
Time value of money. We want to get all of those deductions as quickly as possible. So
I do have a question for you because for California, everything got pushed back for the fires. Did they push back past the renters tax for 2025 or is that
just for city of LA?
Just for the city of Los Angeles.
Yes. Okay. So just for the city of LA. And then when in California, when it's your second year doing it, then you have to pay 50% of what you paid the last year as your initial payment by June 15th.
Okay.
And then the remainder is due.
So there's more rules. Definitely sounds like a professional assistance might be needed for this type of thing. Yeah. It's a lot of rules. Yeah.
And it's a lot of numbers.
Yeah.
And like I said, you have to pay in the in California, you have to pay in the 9.3%. So who's going to calculate the 9.3%? And you have to pay it by December 15th. And if you're not normally ready for your taxes until April, then like what even is that number going to be? And you don't want to be too far off because then you could have late fees or interest that accrues. So because taxes are not due when you file your return, they're due before you file your return. So there's some considerations to take into account, but especially if you're in that marginal tax bracket where you're at 22%, 35%, like it makes a huge difference if you only have to pay 80% of your state income taxes. So
that'd be awesome. So no, that was very informative. Definitely kind of conclusion is it seems like a tax professional would be very helpful for that. Like if you're like interested in it and being like, okay, maybe bring in a professional for it just because it does seem like there's a lot of rules and then dates and then there's like different things to look at. I guess for multi-company people for sure. Yeah.
Especially multi-company. Yeah. If you have one little company, maybe you could do it on your own, but definitely making sure that you're under that 102% threshold is going to be a lot harder. You want to make sure that you're reaching out for that. But a lot of it is you can't ask the questions if you don't even know the conversation.
Of course. Yeah. So. No, still very informative. But it has informed me that I would need a professional.
So this is like one of the best examples that I have of you have a payment that you're required to make, which is your state income taxes. So let's make it a federal tax deduction where you're getting a benefit from it. There's no reason to go out and buy a new computer and spend new money when we have this old money on the table that just needs to be utilized in a different way. And then we can get some benefits from it.
Yeah, 100%. Seems awesome.
So that is a little glimpse into that pass-through entity tax. If you'd like more information, put a comment below or send us an email, and we'd love to hear from you. Talk soon.
Bye, guys.
That's a wrap on Let's Get Fiscal.
Ready to stop guessing and start saving? Click the link in the show notes.
Grab your consult, and let's make your business work for you,
not the other way around. You've got this.